We have a quick question here from a new subscriber, an interesting one, saying that they've seen or read a couple of reports about Softbank and its involvement in the recent tech sell-off, and asks whether the company is really responsible for the moves low we've seen in equities. So thanks for the great question. This has really been the talk of the town in the equity space for the past few days, and there's been a lot of speculation running around, right now about the matter. So do make sure that when you read these types of things, they are very sensational. So do read them with a pinch of salt when it comes to stuff like this. And also keep in mind that I am by no means an expert in option strategies. So I can basically share what I've read about the matter, but there might be more to it than that. Now, when it comes to the recent sell off in the Nasdaq, I don't think SoftBank was responsible for the sell off, but they are rather seen as part of the reason why the index has seen such impressive gains over the past few days, where we saw the Nasdaq basically printing fresh all time highs almost every other session. And the reason why they are linked to this goes down to a option buying momentum strategy that they use to try and basically capitalize on thinner summer liquidity and the recent hype about tech stocks, especially the individual big FANG names like Apple and Amazon, etc. So the word on the street, and of course, according to articles in popular financial news wires, suggests that the company has been buying a huge amount of call options in the big tech names recently. And that position has amounted to about a 50 billion call option position, if I remember correctly. Now, to understand why this helped to drive the prices higher, according to those who are familiar with these types of strategies, it actually comes down to the counterparty to the call option. So think of it this way: if SoftBank buys call options, someone needs to take the other side of that trade. The counterparty that they buy from needs to take the counterparty to that particular trade. So imagine that you are the seller of those call options. You sold them to SoftBank. And that means that as long as the price of those stocks continue to rise, you are sitting in a bad spot because you are the counterparty to that trade. So what they can do to try and offset those losses in the call options, they can try to hedge by basically buying the underlying stock itself. So even though you are losing on the call option, you are making money as long as the actual stock goes up because you are sitting with positions in the actual underlying stock itself. Now, this creates a vicious momentum cycle where the buying and the hedging creates a lot of frothy upside in those stocks. Now, these strategies can, of course, be very profitable, like we've heard from reports, in the right type of market environment, which the recent one arguably has been. But of course, it does carry a lot of risk. And if the market continues to drift lower, it can cause a lot of hurt for the players trading in those type of strategies. Now, the options buying also explains why VIX was rising alongside the underlying stocks. So if you guys remember last week, we actually saw a lot of the equity markets were rising alongside the VIX also moving higher. And the VIX usually moves inversely to stocks. And a lot of participants said that it's due to expectations of rising volatility going into the election, and it shouldn't really be a big cause of concern. But of course, the underlying reason now points to that option buying strategy as the main reason why we saw such a big lift in the VIX, why we saw such a big rise in the volatility indexes. So coming back to your questions, I think looking at these explanations given by some participants, the strategy they used were probably one of the reasons why tech stocks were so frothy, but I don't think they were necessarily the reason for the sell-off. In my opinion, things just got a little bit too high too fast, and this was a well-needed deleveraging and profit-taking and de-risking and just a healthy correction overall in the equity space. But I do still think that as long as the Fed and other central banks are keeping the gravy train going, that the overall bias is still higher from here. Of course, we'll need to wait and see where the market bottoms out. And, we don't have to be a euro trying to pick the bottom. It normally can end badly if we do that. So there's other strategies that we can follow. If the market eventually does bottom out, we can look for potential false break patterns to trade that to the upside, or we can wait for a short-term catalyst to push it higher. We do have the Fed coming up in 2 weeks' time. That can be a catalyst. So we don't have to be a euro when it comes to these types of trades, even though the medium to longer term bias, in my opinion, is still tilted to the upside. We want to be careful and stay out of the way of that volatility and make sure that whenever we do take a stab at trading this higher, that we do so by taking the right type of risk management, because these types of moves can really cause a lot of damage if you don't pay attention. Um, so I hope that helps with the question. As always, any other ones, please don't hesitate to let us know.